following video on private equity and hedge funds is intended for the certified private equity professional participants. The following video explains how hedge funds and private equity are related yet very different. This is based on my personal research as well as that done with the hedge fund group and private equity investment group. What is a hedge fund? Now you know what a private equity firm is, but a hedge fund is very distinct, and sometimes people lump them together, especially when they're regulating. A lot of regulators treat private equity firms as if they're hedge funds, which is very different, and the risks are very different. A hedge fund is a private investment vehicle that charges its investors two types of fees, a management fee and a performance fee. Hedge funds were formed as a way of investing large amounts of capital into strategies that outperform the markets. This is in many ways similar to a private equity firm in the fact that management fees and performance fees are the way they operate. This leads them out a lot of the same type of investors. They're also both in the alternative investment class. So these are some of the similarities, but we're going to go on to the differences and similarities, which will make the distinction between private equity and hedge funds very clear to you. Similarities. They're structured in a very similar way, although private equity firms have a lot more people on staff to deal with their portfolio companies. They use board of advisors a lot more because they go into those companies and they advise them on how best to manage them, and they help the management. But the structure is pretty similar in that both these firms are alternative investment alternative investment funds. They work with a lot of the same people, and they have a lot of the same positions, analysts. They have principals of the funds, and they have people who work with limited partners, and it's very similar in this way. Again, they're similar in that they're in the same asset class. They're both alternative investments. They cater to a lot of the same investors, and sometimes they invest in the same things, but there's a very different way in which they invest. Limited partners, they have institutional investors, family offices, endowment funds, pension funds, high net worth individuals. All these are investors that typically go between private equity and hedge funds. A lot of institutional investors will have an allocation to either private equity or hedge funds, and a lot more times they do both. And so sometimes they'll up their private equity allocation when hedge funds are hot, as it is today, and has been for the last year. They're going to up their allocation to hedge funds and try to get those returns, whereas private equity, they may back off a little bit. But the important thing to note is that they deal with the same type of investors. So this is why a lot of it's transferable, is because they have the same clients. Now, regulation, again, they're both under fire pretty often. Private equity has a bit of a bad reputation, especially because people accuse private equity firms of stripping down companies and making them, although more efficient, they're causing lost jobs. There's been a lot of evidence to suggest this is not true. Hedge funds have to deal with a lot of the same thing. They get a lot of media scrutiny. They're vilified a lot of times in the media, probably to a greater extent than private equity. There are a lot of private equity firms out there, and they don't have to deal really with the public relations problem the way that hedge funds do. And there's always media buzz over hedge funds and whether they're going to get regulated. And in this way, they attract a lot of the same regulation now. The current financial overhaul targets both hedge funds and private equity. The so-called Volcker rule, which would limit banks from having a high ownership interest in private equity or a hedge fund, and would try to push away investment banks from private equity and hedge funds. They treat it exactly the same, as if it doesn't matter which the investment banks are investing in, they're both as risky, is what the regulation suggests, although I think this is very untrue. It's a lot of times the way they're treated. Fees, again, they charge 2 and 20 structure, and 2 for management fee, 20 for performance. Fees sometimes subject to change, but they operate in a lot of the same ways. The larger hedge funds and larger private equity firms will charge a higher rate a lot of times, and smaller firms will charge less. Compensation, again, because the fee structure is so similar, they operate with a lot of the same thing, a lot of the same compensation, in that it goes to the management, trickles down to the other employees. Compensation is very high. Employees, even at the lower rungs of the companies, whether hedge funds or private equity, are being paid very well, and this causes them to trade a lot of employees back and forth. Hedge funds will be able to attract more when they're up and when they're able to promise high compensation, and this keeps both industries paying their employees very well because they don't want to lose one to the other side. Capital raising methods. Because they're dealing with a lot of the same limited partners, and because they have such similar structures and similar payouts to investors, they raise capital in a very similar way. A lot of fundraising is fundraising methods and best practices are transferable to either hedge funds or private equity, especially because you're targeting the same type of investor, and this is very important. Hiring, again, because their compensation is very similar, some of the duties are similar. There's a lot of trading back and forth. Hiring, right now, hedge funds are probably hiring probably a little bit better than private equity firms because they're down, but and hedge funds have been performing so strongly. But hedge fund performance in May was pretty low, May of 2010. So private equity firms may be able to get a leg back up, and again, they both be competing back and forth. Investor relations, because their investors are very similar, they're going to deal with their investors a lot in the same way. Also, they're both a little bit secretive. They don't release as much data as a public company is required to. So their investors have a lot of the same demands, and they have a lot of the same answers to these demands, which is sometimes to not give as much information and to be a little less transparent than investors would like. And investors accept this because they know that private equity firms and hedge funds can bring them higher returns than traditional stocks in many cases. Now that we've talked about the similarities between private equity and hedge funds, we're going to talk about the differences. The differences are in the investments. Specifically, the hedge funds will invest in different strategies. They'll take a macro strategy, different trading techniques in order to outperform the market, whereas private equity firms invest long-term in a specific company and they'll take an ownership stake in it. Hedge funds rarely take a high interest except to sell it quickly within at least a couple of years. A lot of times very much more quick than that. Whereas private equity firms will take a company private for 5 to 7 years, and they're focusing on long-term growth, whereas hedge funds are doing short-term gains, but they're making very huge gains. Now the size of the investment, again, because they're taking controlling interest in companies, private equity firms usually are allocating a lot more money than hedge funds are. There are exceptions to this. Some private equity firms act a little more like a hedge fund, and some hedge funds act a little more like a private equity firm. But overall, hedge funds are taking a minority interest, and they're just trying to make some quick money on very quick trades, whereas private equity firms are focusing on improving these companies, making them more efficient, and generating profit, and sometimes changing management. And this is just a very different way to invest. This is why it is pretty surprising that people don't make the distinction more often between private equity and hedge funds. Now, the duration of investment is also very different. As I said, 5 to 7 years oftentimes for private equity firms, whereas hedge funds, much shorter time, and the exit strategy is a little different. Now with the staff background and talents, a lot of them are very similar, but the staff background a lot of times for hedge funds is more in risk analysis and being able to analyze trade and do quick trades. It's much more focused on the trading aspect of it than it is actual background and business mechanics, and where private equity focuses on these areas. But there are some similarities again. Now for reputation, again, they have a little bit of a different reputation. I said before that they have some of the same media scrutiny, but hedge funds definitely to a larger degree have to deal with their bad reputation, their reputation for creating market volatility. Recently, the euro took a hit, and some people accuse hedge funds of orchestrating this, and at least one hedge fund was investigated because of this. And this is a little different than what private equity firms do. So hedge funds have to deal with their bad reputation. Boom and bust cycles, they're very different. I mean, you look right now, 2009, hedge funds had one of their best years. Private equity firms could hardly fundraise, and they were definitely having sagging performance, whereas hedge funds were doing the best they've done in many years. And the cycles are just very different. Hedge funds a lot of times thrive in a recession, although they didn't from 2007 to 2008. They very much picked it up a lot quicker and recovered a lot faster because there's just a lot of opportunities out there. And private equity firms sometimes will be able to deal with volatility in a poor economy, but a lot of times it hurts their portfolio companies, so they're not able to deal with it very easily. Now, liquidity and leverage. I would say that private equity firms are a lot less liquid because their investments are so long term. So investors are committing their capital to for a lot longer time, whereas hedge funds are pretty liquid because they're making quick trades and they're able to use that capital, get it in, get it out, and they're not leveraging as much as private equity firms are, where they're taking huge amounts of debt with putting down a little bit of actual equity in the company. And hedge funds don't usually use as much leverage because they're not taking over large companies. And it's just a difference in the it's a difference in the investment, and it's a difference in the way they make their money. And I think this video should have made it very clear that although there are some similarities, some very important similarities, especially in structure and who their clients are, hedge funds and private equity firms are very much different, and they deserve to be noted for their distinction rather than lumped together in regulation and just in conversation. A lot of people put these two very different areas together of investment, and there is a major difference between these, and I hope this made it a little bit clearer.